From dreams to reality, my client's journey to financial freedom, and why car loan payments kill dreams, but there's a solution. Hello, everyone. My name is Sylvia Ho, and I'm a financial landlord consultant. I work solely with landlords to help them save money, reduce the income taxes that they pay the government legally, and cut the interest that we pay to the banks. I was working with a couple, and they made good money. They made $319,000, and that was their base. And when you make a lot of money here in Canada, you pay a lot of taxes. So they were at the 53% tax bracket. But one of their dreams was to buy property for their two kids. But they kept on getting declined, and they're like, why am I getting declined? I make a lot of money, right? And they kept on saying, well, your TDS is too high, but they never really explained what that really meant. So as we continued our conversation, we're like trying to figure, okay, what are their financial plans? So when I work with families, I always talk about doing a financial family audit. I figure out how you're running your landlord business, what kind of family obligations you have per month. And for this particular family, they had two car loans, and these car loans equaled $1,100 per month. Car loan payments, everyone, are killers for financial dreams. Every $500 decreases your purchasing power by $100,000. So for them, they were decreasing their purchasing power by just having two car loan payments. Now, obviously, here living in Canada, in Toronto, we need cars, right? We need cars to get around because that's how the society is here in Toronto. So they're like, well, we can't get rid of our cars. We need our cars. So in this audit, we figured out, okay, what if we did a debt consolidation? So what we did, the first step is we consolidated their mortgage. At this time, they owed $550,000. We consolidated their car loans. And we got rid of that $1,100 a month payments, and now their TDS has dropped. What we also did was we moved their amortization to a 30-year amortization. And by having a 30-year amortization, their monthly mortgage payments drop again. And this sets us up for success to be able to purchase other properties. You see, when the banks go loan you money, they base it on your income and they base it on your monthly obligations. The higher your monthly obligations, for example, your mortgage payments or car loans, the lower the loan that they will give you. And that has to do with the TDS. So by refinancing, getting rid of their car loan and going to a 30-year amortization, their obligated monthly payment has dropped dramatically. And what this means is their TDS has room to purchase some rental properties. So that was step number one, is do an audit, figure out where all the money is going, figure out how much you're paying in income taxes, and then come up with recommendations. So for this particular family, it came up with recommendation, we're going to consolidate, go to a 30-year amortization, get rid of the car loans. Now, the second part of the strategy with this particular client is to devise a plan to purchase a property. Now, they had a child going to university, and this child was, I don't know about you guys, but university is really expensive right now. Just to do a basic bachelor degree, a 4-year degree, it's like $100,000, right? So clients right now who have kids going through university, they're feeling the pain because the RESP program that the government created way back when does not take into account all the inflation that's been happening right now. So a lot of parents come to this point where they have their RESP and they've been saving up for two kids, but it's only enough to save up for one kid. Anyways, that was a side tangent, but back to purchasing a property for this child. So for this child going to university, instead of living in res, what they did was what they're going to do is they're going to purchase a condo. They wanted a condo, not a house, because they're busy, right? They have kids, they have family, they have full-time jobs, right? But instead of buying a small 1-bedroom condo just for their one kid to live in, they bought a 2-bedroom plus den. And what that means is they can rent out the other 2 rooms and cover the costs for this condo. So that's pretty cool, right? So it covers the cost for a condo. Instead of 1 bedroom, you're sharing with some friends, develop relationships, and understand, cleaning cycles and all that. But the coolest part about step number 2 about purchasing a property is we used a lesser known government program where they can buy this property for 5% down. That's it, just 5% down instead of the 20% down payment program. And we funded this 5% with the equity in their current home. Pretty cool, right? So they purchased so what just happened here? We refinanced, debt consolidated, got rid of $1,100 car payments, moved them back to a 30-year amortization. Their TDS has dropped. Now the banks are not going to decline them. The second step that we did was we took out extra cash, 5%, plus closing costs to purchase a second property. And the second property, the kid will live in it, plus 2 friends to offset the costs of the condo. Now, if you're impressed with that, listen to the grand plan. So now this client will become a landlord once they purchase a property. Once they become a landlord, they're going to implement the strategy called rental cash damming. And this strategy is a cash flow reallocation strategy which just helps them pay down their owner-occupied home 8 to 12 years earlier than planned. So with the rental income coming in and the projected rental income coming in, now, you know how we moved their amortization on their owner-occupied home up to 30 years? Now, because they're receiving rental income, it will be down to 13 years. How cool is that? So what did we just do here? We refinanced, we went to a 30-year am, we got rid of their car loan, we dropped their monthly obligations, they decreased their TDS. Now they qualify to purchase another property, but instead of putting 20% down payment, we put 5% down payment. This 5% down payment did not come from the savings. It came from the refinance of their equity in their owner-occupied home, so it didn't hurt any of their retirements or their emergency funds or slush funds, right? And instead of paying off their mortgage in 30 years, they're going to pay off their mortgage in 30 years, 13 years. So instead of 30, it'll be 13 years because they applied the strategy called rental cash damming. And when their second child heads to university, wherever that may be, they're going to rinse and repeat the strategy for even greater gains. I am so excited for this particular client. When we put this whole strategy together, my heart was just pumping for them, and I was just like, yes, let's do this. So we're working through the strategy right now. If you are interested in any kind of strategic planning like this, where you're a landlord or becoming a landlord or want to become a landlord, you're a basement landlord, or maybe you have a separate rental property, you can absolutely look at implementing strategies like this. Or if you have a kid going to university, you can implement the strategy as well. It's all about having specific plans in place. By having plans in place, then you have a direction that you can head in. So if you would like a guide to understand how this whole rental cash damming works, please comment below in this Facebook Live guide, and I will send you the guide to show you how this whole strategy can be put together and how you can pay off your mortgage 8 to 12 years earlier than planned. If you love what you're listening to and hearing, please please comment. Let me know that you guys are listening, because it encourages me to make more videos. My name is Sylvia Ho, and I'm a financial landlord consultant. I empower landlords with financial strategies to help them save money, save taxes, and save interest. And I'm also known as the Cash Damming Queen. Take care. Bye now.